We have to see two quite different perspectives. Short term, very bearish, because we think U.S. gas supply is dramatically outstripping the ability of demand to keep up. It's going to blow up inventories. It's going to sink natural gas prices dramatically. But we're actually very bullish on natural gas in North America long term. Two reasons. One is because we think demand is going much higher. It's going much higher because of substitution. Gas is displacing coal in a big way in North America. It's going to accelerate with these low gas prices. And it's going to create a major pull on natural gas supply when we think natural gas supply will actually be weak in North America. Despite what we read in the paper every day, we believe that natural gas in North America has a very difficult time funding itself at these low gas prices. In fact, we think it's only funding somewhere between 15 to 25% of its drilling capex right now with cash flows from natural gas. So that means basically in order to drill all the gas wells we're doing right now, we need somewhere between 75 and 80% cash from somebody else to do that. That's unsustainable, never works, doesn't last. And that tells us that when that capitulation happens in natural gas production, that there'll be a hard time for that natural gas supply ship to turn around.
When you say 80% from other people, are you talking like foreign capital?
Yeah, there's three main sources of capital. One would be hedging gains, which of course are becoming much smaller now. I mean, a couple of years ago, we were getting windfall gains of $3 or $4. From now down, people are hedging it all. They're hedging it sub $5. Second point is from liquids, natural gas liquids. But again, that's still only 15 to 25% of the needed cash flow just to drill wells. And the other part, which we think is about 50%, is coming from other people. Debt, equity, and joint ventures. China's a little bit, most of it's debt and equity actually. The joint ventures are still small in comparison to what the machine needs to feed itself to keep going.
So how long is it going to take for these guys to hit the wall?
It looks to us that they're actually hitting the wall right now. Gas drilling rates are starting to fall. But the problem is that falling gas prices are insufficient to drive these guys to stop because so little of their cash flow actually comes from natural gas production anyway. That even gas prices fall below $3, it doesn't make a big difference to their cash flow. As long as the other three venues are open, hedging gains, other people's money in liquids, they arguably could keep going for a while. But we think the market is starting to get very nervous about the limits to finance companies that currently look at burning cash at a rapid rate, not generating an ROI.
Who are going to be the big beneficiaries from the M&A? What kind of companies are we going to see start stepping in?
Well, there's two groups that are going to benefit. One is obviously the big companies with big balance sheets. The big super majors probably are going to take a much bigger stake. And then the junior and intermediate markets, again, companies with good balance sheets are going to be able to accumulate a lot of assets. So for those with good balance sheets, a good hedging program, we think they're going to have an opportunity to make the best deal they've ever made in natural gas. Our point is, from our timing tools, it's not yet, but we're getting a lot closer.